Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I have on the channel for the very first time, Mr. Howard Chan, founder and CEO of Kurv ETFs, which is relatively new. So Howard, thanks so much for doing this. First time on the channel. How's it going?
Great. It's doing well. Thank you very much for the opportunity to talk about us here.
Yeah, it's my pleasure. Thanks for coming on. I was very, I just sent you an email. Would you like to come on? Sure, I like to come on. And that was it. So this is your first time on the channel, Howard. So you are the founder, the CEO of Kurv, which is a relatively new ETF provider, I believe, that right now has income-oriented ETFs that do covered calls. We'll talk all about them. But first, because it's your first time, tell me a little bit about yourself, Howard, your background, your experience, and then maybe you could talk about also a little bit about Kurv and why you launched this ETF company.
Great, thanks. So even though Curve is a relatively new firm, we're actually a team of folks who've actually worked in the management industry. We calculated like at least 20, 25 years of experience each. And
Okay.
actually, I would 90% of us actually have worked together in a previous firm. We most of us have worked together at PIMCO. Your audience may have heard it was one of the world's largest fixed income managers. So our focus is on yield and income. That's where our expertise is in. And some of us left and have worked at other firms like Goldman, Nuveen, and other large asset management firm. And I think, all of us having had worked in the investment management industry for so long, we see that there are a lot of best practices for large institutional clients, as well as ultra high net worth individuals. That's not really readily accessible to everyone.
Right.
So we all kind of, many of us came together to form Curve, and the mission of Curve is actually to create strategies and tools that are accessible for all, for both large and small investors.
Okay, sounds good. Yes, of course, my audience will know about PIMCO. So, my channel also is all about income and yield. So I'm definitely talking to the right guy. So let's get into it right away, Howard. You guys have, and I'll share my screen real quick, just in case my audience doesn't know, you guys have right now launched one, two, three, four, five, six ETFs. Now, these are ETFs that hold or have exposure to a single stock. So you have an Amazon one, Apple one, Google, Microsoft, Netflix, Tesla. Tesla is the one I'm actually showing on the screen. And so explain to me these funds because they look very, very similar, if not identical, to what YIELDMAX does, right? Where they hold the stocks synthetically by having a long call, a short put, and the cash and treasuries, and then you're writing covered calls on it. Even the fees are exactly the same, 99 basis points. There's a monthly distribution. So tell me a little bit about, why you launched these funds, the idea behind these funds, their objective, etc.
Yeah, I think we maybe, I don't obviously know as much information about competitors, but I know for us, the impetus of launching these ETFs is actually going back to what I just mentioned about the mission. So we were looking at all of the people who we work with, advisors, as well as individual investors. With many advisors, what they have with their ultra high net worth clients is they call up their advisor and say, I want to write some covered calls on this particular name, and I want to generate some additional income. And so these brokers individually have to go through their clients' portfolios, look at what stocks they own, and then figure out, oh, where do I write the options to generate the best income?
Right.
And similarly with individual investors who don't have an advisor potentially to help them out, they have to look through their portfolio and try to do the exact same strategy, right? And so we think that we can potentially remove some of these burdens from the advisors as well as the individual to make this more accessible. So for the advisors portion, this is incredibly not scalable for their business. And the reason is because all of their clients may have different holdings that they have. And then they have to have an execution desk to
Yeah.
execute this. They have to have an option desk to figure out the moneyness of the options, how much premium they're going to harvest. And so it's not really scalable for their business. The individuals, we calculated that if you were to replicate the trades that we make in all 6 of these ETFs, it would be 200, 250 trades a year. And plus, if you do this on a retail pricing level, the bid ask of options is about 10 to 15 basis points for a retail options trading, versus we can help people get institutional trading costs down to 1 to 5 basis points. So what we essentially have done is we wrap these strategies in ETF. We manage all of the operational overhead, we manage the risk within the fund, and we try to also reduce the cost, and then put it in a vehicle that individuals can access easily. There's another aspect to it, is that even if you were able to put these strategies in your portfolio, if you want to exit the strategy, let's say you have like a fast trending upwards equity market, right?
Yeah.
You have to unwind all of these trades. With an ETF, all you have to do is go into your brokerage account, buy a share, and then if you want to unwind these strategies, you just sell a share of that
You just
strategy.
sell it, yeah, like a normal stock. Yeah.
Yeah.
So very, very convenient. So yeah, I totally understand the premise behind it. Let's dig deep now into the strategy. So you have 6 of them. Correct me if I'm wrong, all 6 seems to have a very, besides the underlying holding or exposure, the strategies, everything looks this identical, right? Monthly distributions, the MER is 99, the holdings are identical, like the way it's set up. So let's quickly talk about that, and maybe we could just go with the Tesla one because that's very, very
Sure.
popular. So tell me the strategy behind it. So it looks like you're not holding, you're writing covered calls on Tesla. That would be this one here. You're not holding Tesla stock, you're holding it synthetically, and then most of the cash is in short-term treasuries. Can you just explain the strategy of the fund? And I
Yeah.
guess we'll use Tesla or your Tesla one as the example.
So first of all, there's a reason why we picked these first 6 names, is that generally technology companies do not distribute dividends.
That's
So
true. Yes.
with the exception of Apple and Microsoft, which is
Yeah.
like less than 50 basis points, you
Mm-hmm.
don't get any income when you hold these stocks. And this is why we picked for these first 6 sets to generate some additional income for holding these stocks. Going to the strategy
Yeah.
itself, but when you look at the holdings, you'll see generally that there will be a call and a put that has the same strike.
Yeah.
So it'd be a long call and a short put. And that is what we call a synthetic long that's in the portfolio. It's replicating the exposure of the underlying, in this case, Tesla,
Yeah.
that's in the portfolio. I think the devil's always in the detail. In our strategies, this is not the only way we can replicate the underlying strategy. We can actually hold the actual equity in our fund. And the reason why we want to have the flexibility of doing this is that when you synthetically replicate the long exposure, there is a cost, right? So when sometimes you have a put call skew, so like the calls and the puts are not priced the same. When you roll the options, there's a cost to rolling the options. So a lot of times when you overcome this is that when you buy options, it only takes a small percentage of your portfolio, like
Yeah.
maybe like 10%. And you have the remaining 90% that is in cash, right? So in here, the remaining 3 rows that you see there is invested in short-term treasury,
Very
right?
safe government short-term.
Yeah.
This is like, would you say that's like 0 to 3 month duration?
Yeah, they're less than 3 months, super short duration. And oftentimes, last year, a lot of investors are very concerned about rising rates. What's that doing to the portfolio? And we because we're fixed income folks, we're like, the rates are higher. This is actually the time for you to actually take advantage of the higher rates, right?
Yeah.
So these T-bills actually are yielding 5.5% in the portfolio. Now, we can additionally overcome these costs because we are we have an expertise in fixed income to actually manage this in a way that we can reduce the replication costs in the synthetic long. Now, they're not all environments where we can overcome that cost. And that's why we can actually, in these strategies, hold the long equity. So we want to make that relative value choice between how we replicate the long exposure. And so that's an advantage to the strategies that we have.
Okay, so you're saying that, right now you have the synthetic combo, which kind of replicates the price movement of Tesla. You see here, it is pretty long, right? It expires in April.
Yeah.
But you're saying basically that you have the option to actually hold the Tesla stock if it would be advantageous to the fund in doing so because of trading costs, lower trading costs and things like that.
Yeah,
Do I have that
sometimes
right?
the option markets becomes more expensive. We don't want the investors to pay that cost, so we can hold the long equity if we need to.
Okay. Okay. And this all goes to like professional management, your MER on all of these. This is the total expense of the fund is 99 basis points,
That's
right?
right.
Okay, so tell me a little bit, or let's go into detail about, because I mean they're pretty high yield. I mean the Tesla one is yielding. This is of course based on the latest distribution and on the current stock price, I believe. Not sure how up to date they are, but the Tesla one, obviously high volatility is going to have the biggest option premiums. It's going to probably be the highest out of all of them. You have Netflix at 19. Microsoft, Apple is going to be lower because the stocks are more boring. There's less volatility. Google pretty boring too at 12. Amazon a little bit higher at 15. So talk to me a little bit about the specific covered call options strategy. Is the whole obviously when it comes to covered call strategy, there's really two things to know: the moneyness of the options
Yeah.
and the percentage of portfolio coverage. So can you dig deep into the covered call option strategy, those two factors?
Yeah, so that's potentially going back to your previous questions, another difference between us and other products that are in the market.
Yeah.
So because we come from an institutional perspective, what we focus on very, very keenly is a consistent and generally in line distribution of our funds. And as you mentioned, that cover calls, there's variables, levers that you can pull.
Yeah.
And we tend to take a more institutional approach because, we see these institutionalized version working for large pension funds and high net worth. We want to port that for individuals. We can certainly crank up the yield if we wanted to, but we want to maintain that institutional level to produce a consistent level of income in these funds. So generally, we write our call on a monthly basis.
Okay.
And what we try to do is do it around 30 delta options. And what this is a very key point, is that we want to have a nice balance between price appreciation and income generation. So we know that many people hold Tesla because they have a view that there are some price appreciation in the stock, right? And so we want the NAV to perform similarly, proportionally to what the underlying is doing, right? If the stock is going up and your NAV keeps decreasing, there's something a little funny about that, right? So we want to have that piece of price appreciation. And then we want to write the cover call such that that's wide enough outside, that's out of money enough so that you capture some of the price appreciation. And then beyond that, you're clipping coupons. And when we distribute, we only distribute the income generated from the option writing, not anywhere else in the portfolio. We can always distribute more than we need to, but that's not the goal, right? You don't, when you, let's say you have a rental house, right? You're expecting a certain amount of rent from, somewhere. You wouldn't sell a piece of house just to meet a certain rental yield, right? You would,
Yeah, totally understand what you're saying. So basically, if I have it correctly, you're not exactly, obviously the goal is yield, but you're trying to find that balance, and you're trying to be another thing I heard that a lot of income investors, like especially people who are retired and who want that your distributions are relatively, you want to try to keep them consistent. Right. And the proof is in the pudding. I mean, if we just look at the Tesla one, which could be very hard to keep consistent, you have 57 cents, 66, 55. Then you have here, you have the Amazon one, which is even more consistent. You have 35, 34, 32. Here's, I believe, the Netflix one. Yeah, Netflix, monthly distributions. So far, three have been out, 3 months worth, 43, 45, 43. So yeah, you're right. I mean, they are very, very consistent. So would you say that you're always doing monthly calls, or are you also doing weekly calls, or just like monthly out of the money? Do you have a
Our
systematic approach or an active
yeah,
approach, I guess is what I'm asking.
our basic approach is systematic because we
Okay.
have actually run back tests on these.
Okay.
And we pick the points, the moneyness that we think over many different market cycles works the best. And then we want to be consistent in that approach. There's some active management decision in terms of how we replicate the longs in the portfolio. That's
Mhm.
based upon what market we're in. But generally, the eye to the goal of the fund is to generate consistent income for investors.
Okay. Would you say that the calls are always going to be out of the money because you always want to capture premium? Or at some point, maybe you'll do an at the money, or is it just, it's always 5% out of the money? It's always about 2, 3, 4% out of the money. What kind of moneyness are we actually talking about here with these options?
We generally use delta because depending on how much volatility is in the market, the
Yeah.
delta will shift relative to where the spot is. So we generally will do around 30 delta options.
What
Um,
does that mean exactly for people who are not really that familiar in
Yeah,
percentage
so
wise, maybe?
so it's scaled by volatility. So for instance, you have a stock of Tesla that is
Yeah.
more volatile. So the moneyness will be a little bit wider than say Apple, where the volatility is much smaller. So you'll see it actually closer to spot. So there's a good reason for this, is that when you have a stock that is very volatile, you want to write your call outside enough so it doesn't hit the strike. When it hits the strike, you cap all of your upside. This is
Yeah.
going back to my point about the price appreciation versus income generation, right? And also, if you write your call more frequently, because volatility can go both ways, you sometimes will hit also the strike more often, and so
Yeah.
you clip your upside more. So we put for us, the sweet spot is a monthly call, a 30 delta options on the underlying strategies that you get the price appreciation and you don't always hit the strike. So you're minimizing kind of that clipped upside that you have in a covered call strategy.
Okay. Okay, cool. And just going back to what you said before, that you're only distributing the option premiums that you're getting. You're making interest or on those treasuries. Is that staying within the fund, or is that also being distributed out?
Yeah, if there are excess interest, we will also distribute it out. And to the extent, right now the curve is inverted, so there's no point in taking additional risk out of the curve. But if we see opportunities in investing in slightly higher yielding fixed income assets, we will distribute out. So again, the reason why if we hold the equity long, we
Yeah.
could get dividends if it's a dividend distributing equity. If we do it synthetically, we can get the interest payment. And then on top, if you have cover call, you have that premium on top. So we have three different levers that we can use to generate income for the strategy for the sole goal of a consistent income generation for the fund.
Okay, cool. So I think that pretty much explains everything, all my questions. What I hear is very balanced approach to get you that yield, but also to capture the upside. So I'm hearing like very balanced approach. Last thing I'm going to ask you, I noticed in the prospectus that Neos is the options or the sub advisor, which I'm assuming is managing the options. Neos launched SPY-I, very successful S&P 500, covered call ETFs, and it looks like, I think those guys managed NUSI before or still do. So tell me a little bit about this relationship and why Kurv chose Neos as the guys who manage the options, or do I have it right that they manage the options?
Yeah, so that is correct. They're a sub-advisor of the fund, and
Okay.
they have an expertise in managing options. And what we come to the table is an expertise in managing fixed income, and that's where the collateral is. And so we blend these two
Makes sense.
expertise to generate income, because income, there's a quality of income, there's different sources of income. We don't want to be stuck in just one kind of income. We want to have as many diversified sources of income in our funds. So marrying that expertise from the two firms, we think will give a better outcome to investors over time.
Fair enough. Fair enough. So, last question. You have Amazon, Apple, Google, Microsoft, Netflix, Tesla. Anything else coming in the pipeline, Howard? What can my audience members who are mostly all income investors expect from Curve going forward?
I think it's difficult for us to talk about products that are not out,
I totally understand that.
regulatory constraints. But I will say that our background is in fixed income and crossover fixed income with other asset classes. So we definitely are, we are very interested in generating income generation strategies. So we're
That's
definitely
music to my
looking at
ears.
it. Yeah.
Music to my ears, my audience ears. Howard, this is the first time on your channel. I thank you very much. Hopefully, it's not the last. If you launch anything else, more than happy to have you back on to discuss. I'm always open and try to give my audience members access to the people who are actually managing the funds and not just take my opinion or my word for it. So thanks again for coming on. Hopefully, we'll have you again soon. And good luck with the launch of these relatively new products. We'll be watching them closely. Thanks, Howard.
Thank you very much. It's great to be here. And I hope your audience found this useful.
Perfect. Thanks. Take care.